is to have inflation at about 2%, and that's about midpoint between 1 to 3%. So that'll run until December 31st, 2021. So that's passed. Um, so do you think inflation is at the target right now? Do you think it's at the 2% target, or is it higher or lower? Like, where is inflation right now? So inflation is about 8.1%. They want to bring it down. And one of the ways that they're doing is to increase the interest rate, and that will bring down inflation. So Tiff Macklem is the Bank of Canada's 10th governor, and he was appointed in 2020 for 7 years. So expansionary monetary policies when the Bank of Canada tries to increase the money supply by expanding excess reserves in order to stimulate the economy. So that's usually through lower interest rates. So lower interest rates, higher money supply. And this is usually used to increase economic growth. So that's usually what they do. And then restrictive monetary policy is when the Bank of Canada increases interest rates and lower money supply, reduces economic growth. So where do you think our economy is right now? Like, what do you think the government is doing right now? They're doing expansionary monetary policy or restrictive monetary policy? So they're doing restrictive. So restrictive is a good way to restrict our monetary policy, reduces inflation. They want to bring inflation down from 8.1% to 2%. So they're doing restrictive monetary policy. Bank of Canada's monetary policy tools. They can do open market operations, use the bank rate, change the reserve requirements, and quantitative easing. So Bank of Canada, they can reduce the quantity of money. So in order to to reduce inflation, they can reduce the quantity of money. Also increase the bank rate. They can do that. And the Bank of Canada can set any one of these variables, but it can't set all three. So if the Bank of Canada decrease the quantity of money, both the interest rate and the exchange rate would rise. So then if the Bank of Canada raised the interest rate, the quantity of money would decrease and the exchange rate would rise. If the Bank of Canada lowered the exchange rate, the quantity of money would increase and the interest rate would fall. So the overnight loans rate is the interest rate. And if they want to reduce the money supply, the overnight loans rate will go up. So the Bank of Canada can usually, they can only change the interest rate by a quarter of a percentage point. So in order to change the interest rate, they have to change the quantity of money. So to increase the interest rate, they need to reduce the quantity of money in the economy. And then to reduce the interest rate, they need to increase the quantity of money in the economy. So the so this is how it works. Like the Bank of Canada, they have a bank rate, which is the highest. So like they have a band of like they have the target overnight target rate, which is 1% here. And then they have the bank rate, which is 1.25%, and then the settlement balance rate, which is 0.75%. So they have all three, and they all have to be within 0.5% of a range. So that's how it works. So there's going to be a target rate, a bank rate, and the settlement balance rate. So the target rate is in the middle. The bank rate is at the top. And then the settlement balance rate is at the bottom. Yeah. So the Bank of Canada wants to keep the inflation rate as close to 2% as possible. So when the Bank of Canada lowers the overnight loans rate, the bank buys securities in an open market operation, and then interest rates fall, quantity and supply of loanable funds increase, and then consumption, investment, and net exports increase. So yeah, then so what happens is this is a good flow chart on showing what happens. So the Bank of Canada lowers the overnight loans rate target. The Bank of Canada buys securities in open market operation. Other short-term interest rates fall and the exchange rate falls. Then the quantity of money supply loanable funds increase. Long-term real interest rate falls. Consumption, expenditure, investment, and net exports increase. Aggregate demand increases and real GDP growth and the inflation rate increase. So then the opposite happens on the other end. So if you buy bonds, the money supply increases. If you sell bonds, the money supply decreases. So yeah. So like if the Bank of Canada buys bonds, the money supply increases. And then if the Bank of Canada sells bonds, the money supply decreases. So monetary policy transmission. So when the Bank of Canada raises the overnight loans rate, the ripple effects go in the opposite direction. So what happens is real GDP growth goes down if the overnight loans rate goes up. So interest rates and monetary policy review. So the interest rate is the price paid for the use of money. Equilibrium interest rate is demand for money combined with the supply of money determines the equilibrium rate of interest. So monetary policy is used to keep inflation stable and predictable, to moderate the business cycle, to help the economy achieve full employment and sustained growth. So they want to have an inflation target range of 1 to 3% annually. So monetary policy has open market operations where you buy and sell government bonds, setting the bank rate, having bank reserves, and quantitative easing. So the interest rate goes up. If the interest rate goes up, investment demand goes down. The interest rate goes down, investment demand goes up. So open market operations, Bank of Canada buys bonds, chartered banks reserves increase, banks increase lending, money supply increases, buy equals big. Bank of Canada sells bonds, chartered bank reserves decrease, banks decrease lending, money supply decreases, sell and small. So the bank rate is the interest rate the Bank of Canada charges on the loans to the chartered banks. Bank rate is set at the upper end of the Bank of Canada's operating band for the local lending rate. Bank has a publicized target for the overnight lending rate. Bank of Canada sets a target level for the overnight rate, often referred to as the key policy rate or the key interest rate. Overnight lending rate, the interest rate charged to banks on overnight loans. Bank of Canada conducts open market operations to achieve the target. So what happens with banking system is like you put money into your bank account as a deposit. The bank lends your deposits out as mortgages and loans. Then when you want to withdraw your money, the bank doesn't have your money because they lent your money out to someone else. So the bank needs to borrow from another bank to pay your withdrawal. If another bank doesn't have money for lending, your bank will borrow from the Bank of Canada and pay the bank rates of interest for the loan. So that's how the banking system works. This is how the banking system works all the time. You put money into the bank, and then you put money into the bank lends it out, and then if you want to withdraw your money, the bank has to borrow from another bank to get that money, or the bank has to borrow from the Bank of Canada to get that money. And yeah, that's how it works. The bank doesn't actually have your money. They actually lent it out to somebody else. Yeah. So expansionary monetary policy, economy faces a recession. They lower the target for the overnight rates. They buy securities, they expand the money supply, and then they reduce interest rates. So monetary policy, restrictive monetary policy, is used in periods of rising inflation like right now. They increase the target for the overnight lending rate. Bank of Canada sells securities, increases money supply, increases other interest rates. So then money supply impacts interest rates affect investment. Investment is a component of aggregate demand, equilibrium of GDP has changed. So then money market, investment market. So if there's a recession, the Bank of Canada buys bonds and lowers the bank rate. There's more reserves, the overnight rate falls, money supply rises, interest rate falls, investment spending increases, and aggregate demand increases, real GDP rises. So to get out of recession, the Bank of Canada does expansionary monetary policy through increasing the money supply and reducing interest rates, thereby increasing investment and GDP. So here, when they increase the money supply, aggregate demand shifts right, and money supply shifts right as well. This brings the economy back to equilibrium. So if like right now, this is happening right now. So this is happening right now, right here. So like there's inflation. So inflation is at 8.1%. So the Bank of Canada is selling bonds and raises the bank rate. They are doing this right. Excess cash reserves decrease, overnight rate rises, money supply falls, interest rate rises, investment spending decreases, aggregate demand decreases, inflation declines. So that they are so the Bank of Canada is creating a recession to get inflation down because they want inflation to go down. So they reduce the money supply, and this decreases aggregate demand.